For the first time since 1996, foreign central banks now hold more gold than the US Treasuries. Think about that for a second. The world's reserve currency, the US dollar, the mighty US dollar, is being quietly replaced in balance sheets by gold. At the same time, the global liquidity is surging and retail investors are pouring into stocks, ETFs, and Bitcoin. So what does this all mean for you as an investor, especially if you're in Canada or anywhere else in the Western world? Because this whole USD hegemony is not only benefiting US, but also benefiting the entire Western banking system. So let's break this down. So traditionally, central banks parked their reserves in the US Treasuries because the dollar was considered the safest asset on the earth. But today, for the first time in nearly 30 years, they hold more gold than treasuries. Why? Because confidence in the US dollar is slowly fading away. The dollar's dominance is being chipped away very slowly but surely. Gold is being revalued as a neutral reserve asset. Some regulators even allow banks to hold it as part of their core capital. And when central banks buy gold instead of treasuries, that's a huge signal. The world is hedging against US debt. This doesn't mean the dollar collapses tomorrow, but it does mean the US has to share its dominance in a new multilateral world. Now, here is where things get interesting. If the dollar is losing dominance, shouldn't markets be panicking? Not yet. Because liquidity, the money flowing into the system, is still rising. Take a look at this chart. Global liquidity is at record highs. Despite of all the talk of tightening, there is still plenty of cash sloshing around. And when liquidity goes up, risk assets follow. That's why we have seen Canadian real estate market has already corrected back to 2021 levels in some markets, not everywhere, but in some neighborhoods. Yet, stocks, crypto are still strong. Liquidity is the fuel keeping things afloat. So here is another twist. This isn't Wall Street driving the rally. It's retail investors. People are putting their money into broad market ETFs and Max 7 and Bitcoin at a pace we haven't seen before. Wall Street is skeptical and still hung up on traditional valuation models. But retail investors are saying, I don't want to miss this wave of liquidity. And history shows when liquidity is this strong, staying invested often beats sitting on the sidelines. If you want to really understand these macro shifts, the dollar's managed decline, gold's return, and why liquidity matters more than headlines, that's exactly what I captured in my macro fundamental course. It is designed to help you build conviction in your portfolio decision. Check out the link in the description below if you're ready to join. And if you're looking to put these ideas into action, sign up with Webull using my referral link. You will get $50 worth of free stocks. That's free money you can start investing right away. Okay, now you're going to say, Yasin, this is too much information for me. What should I do with this info? Well, hold some gold. Central banks are buying it for a reason. It's an insurance against US dollar debasement. Number 2, stay invested in equities. Broad market ETFs and even the Max 7 are still supported by rising liquidity. Number 3, don't ignore Bitcoin. The US may even be positioning Bitcoin as a competitor to gold in the long term. Retail flows are strong and Bitcoin's asymmetric upside cannot be ignored. Number 4, diversify globally. Canada is facing trade deficits. Capital is leaving Canada, so don't put all your eggs in one domestic basket. So here's the takeaway. The dollar's dominance is slowly eroding. Gold is back. Bitcoin is rising. Liquidity is still the fuel behind markets. And retail investors are leading this rally while institutions remain skeptical. This is not the time to hide under the bed, but it is the time to be thoughtful, right? Hold some safe assets like gold, stay diversified, and ride the liquidity cycle with equities and Bitcoin. Now, I want to hear from you. Do you think the retail investors are ahead of Wall Street this time? Or is this all going to end in another painful crash? Drop your thoughts in the comment section. Let's debate about it, and I'll see you in my next video. Sorry for the interruption, guys. Just wanted to let you know that I also offer one-on-one consulting calls to the individuals who are looking to discuss their financial planning, their investment strategies, their kids' education planning, their immigration moves, as well as the young professionals, because I have been in the tech industry for almost 20 years. So I also offer one-on-one consulting calls to the young professionals who are looking to have their career development discussion with me, and also personal branding as well. So if you are looking to have some sort of an expert opinion, there is a calendar link in the description below. Book a 30 minutes call with me and I will be more than happy to help you out.